Ladies and gentlemen, this is Finance Shockwave, and what I'm about to show you is the most blatant act of financial theft I have ever witnessed in my career. Stop scrolling, close your other tabs, turn off the notifications on your phone, because in the last 48 hours, something happened in the silver market that the mainstream financial media will never explain to you, honestly. They can't. Because if they did, the entire system would be exposed. Silver just crashed from $79 to $68. $11 evaporated in less than 2 trading sessions. And if you're watching this, you probably felt it. You probably watched your portfolio bleed red. You probably questioned everything. But here's what they're not telling you. While the price was crashing, while $89 billion in paper positions were being liquidated, while retail traders were being stopped out and margin called into oblivion, something else was happening simultaneously. The United States Mint sold out of Silver Eagles. The Royal Canadian Mint went to allocation. The Perth Mint stopped taking new orders. Every major dealer from Apimex to JM Bullion to SD Bullion saw their inventories vanish in hours. Do you understand the contradiction? The price collapsed, but the physical product disappeared. The paper said, silver is worthless. The real world said, give me every ounce you have at any price. This is not a market. This is a crime scene. And today, I'm going to walk you through exactly what happened, who did it, and why you should be backing up the truck right now while the blood is still wet on the floor. For years, we've been told that the futures market discovers the price of silver. We've been told that the COMEX is a legitimate exchange where buyers and sellers meet to establish fair value. We've been told that when the price drops, it's because demand is falling. That narrative died this week. What we witnessed was not price discovery, it was price destruction. It was a coordinated, algorithmic, precision-targeted attack designed to accomplish one objective and one objective only: transfer physical silver from weak hands to strong hands at artificially suppressed prices. And the strong hands? They're not retail investors. They're not hedge funds. They're the bullion banks themselves. The same institutions that triggered the liquidation are the ones scooping up the physical metal at the bottom. They crashed it to buy it. Let me say that again so it penetrates. The banks crashed the price of silver by dumping $89 billion worth of paper contracts so they could accumulate the physical metal at a discount. This is not conspiracy theory. This is observable market mechanics. And by the end of this report, you will understand exactly how they pulled it off, why they chose this exact moment, and what it means for the price of silver over the next 90 days. Let's start with the crime itself, the $89 billion liquidation event. On the morning of the attack, open interest on COMEX silver futures stood at approximately 148,000 contracts. Each contract represents 5,000 ounces of silver. That's 740 million ounces of paper silver being traded on an exchange that has maybe 30 million ounces of registered inventory available for delivery. Do you see the absurdity? For every ounce of real silver, there were nearly 25 ounces of paper claims. This is not a market. This is a casino where the house prints its own chips. At precisely 8:03 a.m. Eastern, during the thinly traded pre-market window, an algorithm triggered. We know it was an algorithm because no human trader would execute this way. Within 17 minutes, approximately 18,000 contracts were dumped onto the market. That's 90 million ounces of paper silver sold in a quarter of an hour. The price didn't just drop, it cratered. It went from $78.50 to $71 in those 17 minutes. Every stop loss below $75 was triggered. Every margin call was activated. Every leveraged long position in the retail space was annihilated. But the algorithm wasn't done. As the stops triggered, more selling cascaded. The machines fed on the carnage. By the time the dust settled at 11:30 a.m., silver had touched $68.20. The total notional value of contracts liquidated exceeded $89 billion. $89 billion. That's not a correction. That's a controlled demolition. And who was on the other side of those liquidations? Who was buying when everyone else was forced to sell? I'll give you one guess. The commercial traders, the bullion banks, JP Morgan, HSBC, Bank of America. The same entities that the CFTC's own Commitment of Traders report shows have been net short for years, suddenly reduced their short positions dramatically during this crash. They didn't just buy the dip, they manufactured the dip so they could buy it. Now let's look at what was happening in the real world while the paper market was burning. At 9:15 a.m., approximately 1 hour after the crash began, the United States Mint website showed zero availability for American Silver Eagles. Not low inventory, zero. The product page displayed currently unavailable. Phone lines to authorized purchasers were jammed. By 10 a.m., Apimex had raised their premium on Silver Eagles from $6 over spot to $11 over spot. And they still couldn't keep them in stock. JM Bullion followed with a $12 premium. SD Bullion hit $13. Think about what this means. The spot price said silver was worth $68. The actual price to buy a real physical silver eagle was $68 plus $13, which equals $81. That's higher than where spot was before the crash. The paper price crashed. The physical price stayed elevated. The premium exploded to levels we haven't seen since the March 2020 panic. Meanwhile, the Royal Canadian Mint issued a notice to dealers that silver maple leafs were on allocation. That's the polite way of saying we don't have enough metal to fill your orders. The Perth Mint in Australia stopped accepting new orders entirely for their silver kangaroo coins. Every major online dealer reported the same phenomenon. Traffic spiked 400% during the crash. Buy orders overwhelmed sell orders by a ratio of 7 to 1. Retail investors weren't panicking. They were pouncing. The public understood what the paper price was trying to hide. This wasn't a collapse in demand. This was a fire sale, and everyone with cash was grabbing everything they could carry. So why didn't this buying pressure push the price back up immediately? Because the price isn't set by physical buyers. The price is set by paper traders on the COMEX. And the paper traders were in liquidation mode, which means the price could be pushed anywhere the algorithms wanted it to go, regardless of what was happening in the real economy. Let me walk you through the mechanics of this attack step by step so you understand exactly how the banks pulled it off. Step 1. Accumulate a massive short position over the previous weeks. This is visible in the QOT data. Commercial traders added approximately 12,000 net new short contracts in the 3 weeks leading up to the crash. They were loading the gun. Step 2. Identify the leverage points. The banks have access to data that retail traders don't. They know where the stop losses are clustered. They know which hedge funds are over-leveraged. They know the exact price levels that will trigger cascading liquidations. They map the battlefield. Step 3. Choose the moment. Why did they attack at 8:03 a.m.? Because that's the lowest liquidity window of the trading day. The Asian markets have closed. The European markets are in lunch mode. The US market hasn't fully opened. A sell order that might move the price 50 cents during peak hours can move it $3 during this window. They attacked when the market was weakest. Step 4. Deploy the algorithm. In 17 minutes, 18,000 contracts hit the market. This isn't speculation. This is visible in the time and sales data. The selling was concentrated, mechanical, and relentless. It was designed to overwhelm the bid stack and trigger the stops. Step 5. Let the cascade do the work. Once the stops triggered, the banks didn't need to keep selling. The margin calls did the selling for them. Retail traders who were long on leverage were forced to liquidate. Hedge funds running momentum strategies flipped to short. The machine fed on itself. Step 6. Cover the shorts at the bottom. While retail was being liquidated, the commercials were buying. They covered their short positions at $68 and $69 and $70. They bought the contracts that retail was being forced to sell. They didn't just profit from the crash. They used the crash to accumulate a long position for the next leg up. This is the playbook. It's been used dozens of times in the silver market. But this particular attack was notable for its scale and its precision. $89 billion liquidated in half a day. And the banks walked away with both the profits from their shorts and a new long position at fire sale prices. So why did they choose this specific moment to execute the attack? What made this week different? 3 converging factors created the perfect conditions. First, the China situation. We've been covering the Chinese export license ban on silver that goes into effect next week. The market was front-running this news. Silver had rallied from $50 to $79 in a matter of weeks. The bullish sentiment was extreme. Everyone was positioned for $100. When everyone is leaning the same direction, the banks push the other way. Extreme bullishness creates extreme vulnerability. The higher the price goes on leverage, the more fuel there is for a liquidation cascade. They let the market get euphoric precisely so they could harvest that euphoria. Second, the options expiration. This crash happened 3 days before a major options expiration on the COMEX. Billions of dollars in call options were set to expire in the money at prices above $75. If silver had stayed at $79, the banks who wrote those calls would have owed massive payouts. But if silver crashed below $75 before expiration, those calls expire worthless. The banks keep all the premium. The options buyers get nothing. This attack wasn't just about the futures market. It was about stealing the options market too. Third, the delivery window. We're approaching a major delivery month on the COMEX. Traders who hold contracts into the delivery window can demand physical metal. If too many traders stand for delivery, the COMEX runs out of registered silver and the game ends. By crashing the price and liquidating the longs, the banks dramatically reduced the number of contracts that might stand for delivery. They flushed out the buyers, who actually wanted metal. They replaced them with speculative shorts, who just want to trade paper. The delivery threat was neutralized. These 3 factors, bullish euphoria, options expiration, and delivery risk, created a perfect storm. The banks saw their moment, and they took it. Every bullet fired at once. Let's talk about who got hurt and who profited from this attack. The victims are obvious. Retail traders using leverage, anyone who bought call options in the past 2 weeks, anyone who had stop losses set below $75. These people didn't just lose money, they were specifically targeted and harvested. The hedge funds running momentum strategies also got crushed. These are the quant funds that use algorithms to chase trends. When silver was going up, they were long. When it crashed, their algorithms flipped them short at exactly the wrong moment. They sold the bottom and will buy the top. They're not smart money, they're fast money, and fast money gets eaten by patient money. The miners took a hit, too. Companies like First Majestic, Pan American Silver, and Endeavor Silver saw their stock prices drop 15% to 20% during the crash. These are the companies that actually produce the metal the world needs. They get punished while the banks profit. Now let's talk about the beneficiaries. JP Morgan reduced their short position by an estimated 8,000 contracts during the crash. At 5,000 ounces per contract, that's 40 million ounces of paper obligation they eliminated at the bottom. HSBC and Bank of America showed similar patterns. The commercial net short position, which had been at extreme levels, contracted dramatically. The banks are now less short than they've been in months, but here's the real prize. While they were covering their paper shorts, they were also buying physical metal through their vault operations and through their custodial arrangements with the ETFs. The SLV ETF, which is custodied by JP Morgan, saw inflows during the crash despite the price dropping. Someone was adding physical silver to that trust. Who adds silver to an ETF when the price is crashing? Someone who wants to accumulate metal at discount prices. Someone who knows the price is about to reverse. Someone who just orchestrated the whole damn crash. The banks are now positioned for the next leg up. They covered their shorts. They accumulated physical. They eliminated the leveraged longs who might have competed with them. They cleared the battlefield. Zoom out for a moment and consider what this event reveals about the entire financial system. First, it proves that the paper price and the physical price are now completely divorced. The paper market can say silver is worth 68, but if you can't actually buy silver at 68, what does that price mean? It means nothing. It's a fiction. It's a number on a screen that has lost its connection to reality. Second, it proves that the COMEX is not a price discovery mechanism. It's a price control mechanism. The banks use it to set whatever price they want whenever they want. Supply and demand for physical metal have no impact on the paper price in the short term. Third, it proves that the regulators are either complicit or incompetent. The CFTC has position limit rules that are supposed to prevent this kind of concentrated selling. Those rules are not enforced. The CFTC has manipulation statutes on the books. They are not applied. Either the regulators are in on it, or they're too captured by the banks to do their jobs. Fourth, and most importantly, it proves that the banks are preparing for something big. You don't go to this much effort to accumulate physical silver unless you believe the price is going much, much higher. Think about the logic. If silver was going to stay at $70 forever, why would the banks risk a massive coordinated attack to accumulate more of it? Why would they need the physical metal? Why would they be draining the COMEX and the ETFs and the mints? They're positioning for a repricing event. They see something coming. Maybe it's the China supply shock. Maybe it's a dollar crisis. Maybe it is an industrial panic as the solar and EV industries realize they can't get enough metal. Whatever it is, the banks are betting their balance sheets that silver is going dramatically higher, and they want to own as much of it as possible before that happens. This crash wasn't a warning to stay away from silver. It was the final accumulation before liftoff. So what happens now? Let me give you the roadmap for the next 30 to 90 days. In the immediate term, expect volatility. The banks may try another smash to shake out anyone who bought the dip. They want your coins. They want you to panic sell so they can buy more physical at discount prices. There may be another drop to $65 or even $62 before this is over. Do not sell into weakness. Watch the premiums. If the spot price drops, but the premium on physical metal stays high or goes higher, that's your confirmation that the paper price is fake. The premium is the truth serum. It tells you what real buyers are willing to pay. Watch the COMEX inventory. The registered silver on the COMEX has been draining for months. Every delivery month, more metal leaves than arrives. If we see a dramatic drop in registered inventory after this month's delivery window, it means the banks are pulling metal out of the system. That's the precursor to a supply crisis. Watch the COT report on Friday. This report will show us exactly how much the commercials covered during the crash. If they reduce their shorts by more than 10,000 contracts, they're positioning for a major rally. The bigger the reduction, the higher the target. Here's my base case for the next 90 days. We consolidate between $65 and $75 for the next 2 to 3 weeks. The banks will paint the charts to look bearish. They'll try to convince you the rally is over. Then, sometime in early February, the China supply shock hits for real. Industrial buyers panic. The banks step back. and silver rips to $100 faster than anyone expects. The crash you just witnessed was not the end of the bull market. It was the intermission. The second act is about to begin, and it will be far more violent than the first. So what do you do with this information? Let me give you the specific action steps. Step 1. Do not sell your physical silver. This is exactly what the banks want. They want you to look at that $68 price, panic, and dump your stack onto the market where they can scoop it up. Your physical metal is not an investment to be traded. It is insurance against the system. You don't cancel your insurance because the premium fluctuated. Step 2. If you have dry powder, this is the buying opportunity. The banks just gave you a gift. They artificially suppressed the price so they could buy. You can buy at the same prices they're paying. You're getting the same deal as JP Morgan. How often does that happen? Step 3. Avoid paper products. The SLV ETF, the futures market, the mining stocks on margin, these are all tools the banks can use against you. They can crash the paper price anytime they want. They cannot crash the price of the metal sitting in your safe. Physical in your possession is the only silver position they can't touch. Step 4. Ignore the mainstream narrative. In the next few days, you're going to see articles explaining why silver crashed. They'll blame it on a strong dollar, or rising yields, or reduced industrial demand. These are lies. They're cover stories for the manipulation. The fundamentals didn't change. The supply deficit didn't shrink. The solar industry didn't stop needing silver. Nothing real happened. Only the paper price moved. Step 5. Be patient. The banks have been manipulating this market for 15 years. They're not going to stop because of one rally. There will be more attacks. There will be more volatility. But the trajectory is clear. Physical silver is scarce and getting scarcer. Paper silver is infinite, but increasingly worthless. Eventually, the physical market will break the paper market. You want to be positioned before that day comes. I want to leave you with some perspective. If you held your physical silver through this crash, you did exactly the right thing. You didn't fall for the trap. You understood that the paper price is a temporary illusion, and the metal in your hand is permanent wealth. The banks spent $89 billion trying to shake you out of your position. They failed. You're still here. You're still holding. And now you know their game. You know they crash the price to accumulate. You know they attack at low liquidity windows. You know they target at the leveraged longs. You know the premiums reveal the truth the spot price tries to hide. This knowledge is your armor. They can't trick you anymore. The next time you see a crash, you won't panic. You'll recognize it for what it is, another opportunity to buy what the banks are buying at the prices the banks are paying. You're not fighting the banks. You're front-running them. You are accumulating the same asset they are accumulating, and you are doing it with zero leverage and zero counterparty risk. Your silver is in your possession. Theirs is on a balance sheet. When the system breaks, and it will break, your metal will still be there. Their paper claims may not be. The $89 billion liquidation was not a defeat for silver investors. It was a revelation. It revealed the desperation of the banks. It revealed the divorce between paper and physical. It revealed that the end game is approaching. The mints are sold out. The premiums are exploding. The banks are accumulating. The supply crisis is real. The only question is whether you'll be positioned correctly when the repricing happens. This is Finance Shockwave. If this report helped you understand what just happened in the silver market, hit the subscribe button and the notification bell. Share this with anyone who panicked during the crash. They need to understand the truth. The shockwave is coming. Make sure you're not standing in the blast zone. I am Jason Ahn from Finance Shockwave. I'll see you in the next report.